All right, how diversification reduces risk. So this is a follow-up video to one that we made about a week and a half ago on risk controls and quantitative investing. This is going to go a little bit further down the rabbit hole of diversification and how that functions from a mathematical standpoint. I think it's important to understand because although everyone has at least heard that you should be diversified in your long-term portfolio, I think this is misunderstood to some degree, but probably just done poorly across the board by a lot of people. We'll talk about why that is. Before we get into anything, mandatory disclaimer here. So this presentation is for informational and educational purposes only and does not constitute investment, financial, legal, tax, or any other form of advice. The views in this presentation are purely the views of myself and do not necessarily reflect Enders Capital's position. Enders Capital Management LLC operates under Regulation D, Rule 506C, with investments available only to verified, qualified clients via official documents. No warranty is made on the accuracy, completeness, or suitability of this information, and risk control discussions are general. Investing involves significant risk, including loss of principal, and past performance is not indicative of future results. No guarantee of objectives or loss avoidance is made. Any references to Enders Capital are illustrative and not a solicitation. Please review the fund documents before investing. Consult qualified advisors for suitability. For more information, you can visit enderscapital.com. Excuse me. So, who am I? There's my ugly mug once again. So my name is Risley Mobile. I hold a bachelor's degree in chemistry with minors in mathematics and physics. In undergrad, I spent most of my time on the math and physics side of the department, and my research in undergrad was in physics. I also hold a medical degree from the University of Iowa and am currently in residency to become a diagnostic radiologist. However, for the purposes of this presentation, I am the COO and head of research at Enders Capital. So in the video, we're going to talk about just, again, reintroducing everyone to this idea of diversification and risk, but really focusing in on the core concepts of returns and how we think about and calculate those, risk and how we think about and calculate that, and correlation and its role in risk. So to do that well, we're going to have to talk about some of the mathematics behind it, looking at portfolio formulas, variance and return formulas, etc. And then hopefully we're going to build some intuition with some examples and analogies and try and visualize why this diversification thing works the way that it does. So what is diversification? Well, diversification is just the distribution of risk across multiple assets or strategies to reduce the overall risk of the portfolio without necessarily sacrificing returns. The reason this is important is because it reduces your exposure to any single asset or strategy's potential failure. Businesses blow up, algorithms break, strategies bleed edge over time. So these are all important. And if you're too exposed to one of them and it blows up, well, then so does your portfolio, which is not something that is acceptable. So the focus of this discussion on diversification is going to be to look into the mathematics a little bit and talk about how uncorrelation drives these benefits of diversification. So we have to talk about risk in investments and how that is defined. And we define risk really as the volatility, which is measured by the variance or standard deviation of returns. So you can make an assumption that you have an asset that only goes up and to the right and returns, call it 10% a year, but the risk is the wiggles along that path to 10% a year. And the way that we measure that really is statistically by looking at the standard deviation of the returns and then from the standard deviation calculating the variance. So your single asset risk can be really high if you have a really volatile asset that you're trading. For example, if you're trading a small cap that's swinging 20% intraday, that's a lot of volatility in your portfolio if it's a significant holding. So ultimately that is some high risk in your portfolio, which is why we talk about this idea of risk adjusted returns, and you can reference the previous video for a little bit further clarification on that. So the portfolio risk is not just the average of the individual risks that you hold in your portfolio, and that is because there are going to be varying degrees of correlation between the assets in the portfolio, so you have to account for how those assets interact. For example, Historically, a common example was like stocks versus bonds, equities versus bonds, and how, at least you're supposed to have some uncorrelation between those two. And the degree and the interaction of that correlation is ultimately what contributes to portfolio risk in that setting. The gut feel for this risk here really is like the bumpiness that you experience along the way to whatever it is. So if you're annualizing 10%, but you're feeling 25, 30% drawdowns and big swings in your portfolio, that's the risk. That's the gut feel that you have as to the risk of your portfolio. All right, here's the math. Don't freak out. We'll walk through it nice and slow. So expected returns really is just the weighted average of asset returns. It's just simple addition of them. So this equation here says that the returns of the portfolio, or R sub P, is equal to the sum of, and then we have asset 1, so the return of asset 1 times the weight of asset 1 plus the return of asset 2 times the weight of asset 2. So you're just summing up weighting times return, and then you sum all of your assets across the portfolio. That's your expected return. Excuse me. However, risk is not additive, and very importantly, depends on the correlation between the assets. So again, what we're looking at here on the right is the variance, so it's the square of the standard deviation. So the variance of the portfolio is equal to, and we have this omega, again, is weighting here, of asset 1 squared times the variance of asset 1, plus the weighting of asset 2 squared times the variance of asset 2. Makes sense so far, but looks very much like simple addition up here. It's just got some squares on it because we're looking at variance. But there's this third term, and this third term is what describes the interaction between those two assets. So the one symbol that we haven't seen yet here that we now see is this rho, looks kind of like a P, and it's rho sub 1 comma 2, which is telling you that it's the correlation coefficient, or a measure of the correlation between assets 1 and 2. So it's telling you how correlated those two things are. And if the assets are uncorrelated, portfolio risk drops below the average individual risk. How does that work? Well, let's take a look at this calculation of portfolio variance a little bit closer. I'm going to try and get a pencil up here. So I'm pointing you to this guy, the rho sub 1 comma 2. So let's plug in some different values. So correlation coefficients can range from -1, which would be a perfect inverse correlation, to +1, which is a perfect correlation. So if you have a correlation coefficient of 1, you expect those assets to move in lockstep. Asset 1 goes up, so does asset 2. Asset 1 goes down, so does asset 2. 0 would be perfectly uncorrelated, meaning there's no relationship on how they move versus each other. And the -1 would be an inverse. So anytime asset 1 goes up, asset 2 goes down, and vice versa. So thinking about that range of values from -1 to 1, we can see that if we plug in a 1, which is the maximum possible value for this, then rho becomes 1 right here, and you maximize the entirety of this term. What I mean by that, for you folks that didn't spend as much time in the math department, let's plug in a different value and you'll understand what I mean. What if rho was 0? You can see that rho is multiplied by everybody inside of this. So if it's 0, this whole term goes away, and then the remaining variance is just the sum of these two terms. So a correlation coefficient of 0, that whole term disappears. And then where things get really interesting is once you get into some negative numbers that you're plugging in here for the correlation coefficient. So if we have, for example, -1, then this whole term is still calculated. However, the plus sign goes away and you actually subtract that term from the previous two, which is going to have the net effect of decreasing the total portfolio variance. Huh, that's pretty weird, huh? So why not always try and shoot for perfectly inverse correlation? Well, it's because it's hard to find perfectly inverse correlations that also produce returns over time. That's one of the caveats here of the expected returns versus risk. If we come back up to this guy, is ultimately to have positive portfolio returns, we have to have assets that do each produce returns over time. We can have perfect inverse correlation and have flat returns with minimizing portfolio variance, but that's not super useful. So that's kind of the important thing that I want you to take away from looking at this, is it's all about the effect and control of your portfolio level variance is all about the correlation coefficient between the assets in your portfolio. All right, let's look at some visuals. That's enough math for today, and see what happens. So this is a simulated portfolio. This is data that I produced for the purpose of this illustration. This isn't any strategies or anything. So you can see on the bottom, we've got all these dashed lines which represent individual assets. The green ones had good returns, the red ones not so much. And then this solid blue line is the net portfolio that's holding an equal weighting of all 5 of these assets. So you can see we've got these different periods of different assets. Maybe like this one has a big drawdown and then has a really long period of underperformance before finally really outperforming in the back half of the year. We've got one asset that's outperforming a lot. We've got these two that are just kind of lackluster. All of those are pretty dramatic roller coaster rides if you're only holding those. But when you look at the portfolio level, the result is to really smooth out and give us these nice consistent returns. Even though only 3 out of 5 of our assets are actually producing returns, we're able to reduce our risk a lot by just having a much smoother return at the portfolio level. So when we look at the statistics for this, we can get some hard numbers here about the individual assets, their returns, and their drawdowns. So for example, asset 1 returned 74% over the simulated period, but it had a 33% drawdown. I'm not personally interested in ever seeing a third of my money disappear while holding an investment. Asset 2 actually is pretty awesome, 96% return with only a 14% drawdown. Asset 3, negative return, basically flat, but still had a 33% drawdown, which kind of hurts. And you can kind of take a look at all those. But when you equal weight these things in the portfolio with their degrees of uncorrelation, the total return at the portfolio level is about 50.47%. And our drawdown is only 12%, which compared to these bigger numbers of, in the 30s, much easier to tolerate a 12% drawdown. So correlations we're going to talk about in a different example here. So we're switching up. This is not simulated data. This is back-tested data from some algorithmic strategies. Again, the dashed lines are individual strategies. The solid blue line is the equal weighted portfolio, and then green is the S&P 500 there, just for reference. So this is an actual back test of data over the last 12 months from yesterday, which is January 28th. And we're going to take a little bit closer look at this one. I want you to take note, this is April of 2025 right here, this kind of big dip in both the portfolio and the S&P 500. We're going to come back and we're going to talk about that specifically because it helps point out one of the common pitfalls in diversification. But you can see when you look at the individual strategies, we've got a couple of really solid performers, but even some of the solid performers stay flat for a really extended period of time while others are moving around and doing things. So even though we could potentially select our better performers, we're going to end up experiencing 6 months of drawdown of sideways action essentially. But when you equal weight these things, what you end up with is generally a pretty nice smooth P&L curve that continues to move up and to the right, which ultimately is what we want. So when we look closer at these guys, mug out of the way, we can look at the correlations between them on the right side here. So this is the mean correlation during drawdown of each of these strategies with respect to the others. So we've got a long short NASDAQ strategy, a large cap strategy, gold, safe sector, and emerging markets. So you look at the correlations here, you see 0.4, 0.3, 0.05, 0.3, 0.2. These are all pretty good, honestly, in the quantitative world. When you're running a lot of big strategies like this, it's hard to do better than that. You can, but it's hard. So this is just a decent example of like some pretty low correlation stuff to each other where you can reduce some risk. What's interesting is I put the correlation of all 5 of those strategies against the S&P, and when you have these guys in a portfolio, their correlation to the S&P is only about 0.4. So 40% of the time they're moving with the S&P 500. That's interesting. So you can look at individual cumulative returns of these guys. You see 125, 45, 88, 48, 20. But then when you look at the max drawdown, you see some big numbers too: 16.9, 15.86, 10, 11, 8. But when you take all of these and you equal weight them into a portfolio, what you end up with at the portfolio level is a cumulative return of 64%. Still pretty good. But our max drawdown is reduced to 8.57%. Now, when you run these back tests for longer periods of time, and again, these are just back tests, these aren't necessarily anything that we're running or anything like that. But it gets more obvious over longer periods of time when you see bigger drawdowns in the individual strategy levels. At the individual strategy level. How much you can really get a reduction in the drawdown of your strategies. But this is pretty solid for a year of performance. The only, not even double-digit drawdown, while the S&P did have double-digit drawdown, I think 22% over the same time period. And we're still eking out a 65% return. So we're not giving up any returns here at the portfolio level, but we are smoothing out our path to get there. Our Sharpe ratio here, risk-adjusted returns of about 2.7. That's pretty solid. So hopefully this is where the light bulb's kind of starting to go off. Okay, we're still basically getting the average of these as the cumulative return, but the max drawdown is significantly less than some of these higher drawdowns here. So sweet. All right, I told you I was going to talk about this guy. This is going to move us into the common pitfalls of diversification. And this is probably the most important one in my opinion, which is that correlation is not constant between assets. And it is worth looking. This is part of why we back test the way that we do, which we'll talk about in the future. We're very careful about how we do this. But ultimately, when fear spikes, so think COVID initial reaction, 2008, those sort of things, correlation among assets also tends to spike. I wrote an entire white paper about this. It's on the website. You should go read it. But the point is, when fear spikes, correlation spike, things tend to move together. And they move together because all assets just go lower. That's true of a lot of different types of bonds, even some fixed income products, equities, energy. All of those things tend to move in lockstep. So whenever you're constructing a portfolio, it's really important that you're thinking about the uncorrelation in times of true fear and doing something to try and understand how that's going to function. Because ultimately, the times of true fear are when you really, really care about the uncorrelation in your assets and the protection that provides you. So it matters. This is not a portfolio that we're running, but this is an important thing to look at, to look back to April of 2025 when we had some really vicious selling in equities, and to look at this and go, okay, it looks like these things do get pretty correlated whenever fear is elevated. It's useful information and important to take note of. So that is one of the common pitfalls, is making the assumption that correlations always stay constant. That is not true. Over diversification, I don't know if I really want to talk about this too long or not. I might make a different video about this, but ultimately, once you get above about 20 or 30 assets and or return streams, strategies, whatever, this can reduce your returns. It can start to reduce your terms. The reason's a little bit complicated and too nitty-gritty, I think, even for this video. But the point is, if you can find 15, 20 uncorrelated assets to hold in your portfolio, you're kind of maximizing the benefit of this. And then another common pitfall is to ignore weighting and rebalancing at the portfolio level. So as you have periods of outperformance or underperformance for assets, your allocation will change to those because the value is changing. If you want to maximize the protection that you get from diversification, then you need to rebalance over time, meaning take some profits off the winners and redistribute that risk evenly across the portfolio. It just means having the same amount invested in each of the assets or strategies over time. So for us at Inverse Capital, we rebalance every day essentially between our portfolios. So between the individual strategies. So we're always having an equal weighting to the strategies that we're running. All right. I think that's pretty much it. So key takeaways here. The mechanism via which diversification reduces risk is uncorrelation of the assets. And we saw that mathematically. Hopefully we saw that in the examples. We have some gut intuition for why that is now. The intuition here is that there's some degree of canceling out at the individual asset or strategy level, which smooths out the volatility and the portfolio level ride that you experience. And then the kind of gut feel to me here is lower covariance, so lower correlation and lower variance similarities between the assets and strategies means less drag on the portfolio's stability. So key takeaway, always consider correlations when you're building portfolios for the long term. All right, that brings us to the end. If we're not connected already, let's get connected. You can find me on LinkedIn. There's my little QR code there. We'll continue making some videos. This is a pretty nitty-gritty video. We're going to kind of broaden out and make videos on lots of other things over the coming months. If you want to know more about Inders Capital, you can go to inderscapital.com. You can email me at risley@inderscapital.com. Connect with me on LinkedIn, whatever you want to do. If you have questions or topics that you want us to make videos about, just let me know. I'm happy to either answer questions or make specific videos if it's helpful. All right, that's it for today. I will see you in the next one. Peace.